Hello guys, this is Billy FS once again, and in this video I am going to teach you a simple trick that is going to help you identify supply and demand zone easily on the charts without any hassle. So please, if you are new to the channel, make sure to like and subscribe to help us grow the channel, and if you have any questions you can leave them in the comment section and I'll come and attend to you personally. So without much ado, let's get straight into the content. Now, before we talk about the trick that we need to use, we need to go through especially the first 3 points over here. We have to understand what supply and demand is. And we also have to know how does it look like on a chart. Because if I tell you the definition of a supply and demand and you are not able to identify it on a chart, then it doesn't actually make sense. It is not going to be of any use to you. So after you know the definition of supply and demand or the meaning of supply and demand, you should know how it looks like on the chart, right? Then you should be able to see where to find them, right? So we know the definition, we know how it looks like, and you know where to find it on a chart, right? Then after that, we go through a few examples, and that will be all for that video. So let's look at the first point. What is supply and demand? I'm going to make this as simple as possible without any complication so that even a beginner can what follow, right? Now, let's first of all talk about supply. When you're talking about supply, it simply means that sellers are coming into the market. I know that the definition for supply according to economics is a little bit complicated, but we don't need that. In a context of trading, just see it this way. Supply simply means that sellers are coming into the market, right? And when sellers come into the market, how is that going to be represented on a chart? It's going to be a candle that has closed what? Bearish. So it means that supply has come into the market. When a candle closes bearish, supply has come into the market. Okay, now let's look at demand. What does demand mean? Demand simply means buyers are coming into the market or buyers are in the market. So when that happens, how is that represented on the chart? It is represented by what? A candle closing bullish. Very simple. So when you see a candle closed bullish, it means that demand is in the what? In the market. All right. So now let's talk about how does it look like on a chart? How does supply and demand looks like on a chart? Let's take the supply first. Now, when you actually study supply and demand for a very long time, you realize that a supply zone is just a bearish engulfing candlestick pattern. We all know bearish and bullish engulfing candlestick pattern because these are the first things that we see on the internet when we search about technical analysis or trading. So a bearish engulfing candlestick pattern is just a bullish candle that has been taken over by what? A bearish candle. So you can see this small bullish candle that is sitting over here. Then you can see this huge bearish candle that has taken over the body of this bullish candle. So it means that when you take a rectangle tool, then we mark the, the bullish candle, that becomes what? A supply zone. So we anticipate the market to what? Rise to that supply zone and what? Fall, right? Now let's talk about the demand zone. The demand zone is just a bullish engulfing candlestick pattern, right? So it's just a bearish candlestick being engulfed totally by a bullish candlestick. We take a rectangle tool, then we mark that bearish candlestick that has been what? Engulfed. It can be a single candlestick or a series of what? Candlestick. The same thing applies to what? The supply. It can be just one bullish candlestick or a series of what? Bullish candlestick. The most important point is that if it is a series of candlestick, they must all be engulfed or taken over by that bearish candlestick, right? So for the bullish one, the same thing applies. We anticipate that the market what comes into that demand and what move away from there. So this is how it looks like on the chart. Bullish engulfing candlestick and bearish engulfing candlestick patterns. All right. Now let's look at where to find them. Where do I look to find this bullish engulfing candlestick pattern and this bearish engulfing candlestick pattern that denotes supply and demand? Now, they are found at the tip of candles, at the tip of candles, right? So I said that supply simply means that sellers are coming into the market, and that is represented by what? The market closing bearish or price closing bearish, right? So if price closes bearish, it means that the look at where the price started. It opened somewhere over here, then it closed somewhere around here. So it means that the sellers took the market from here, then they brought it down to this place. So where do you think the sellers are going to be located? They are going to be located at the tip of the candle here, at the tip of the bearish candle. right? The high of that bearish candle. That is where the sellers are going to be located. And let's look at where the the buyers are going to be located for the what? For the demand. So we have the bullish candle that is representing buyers coming into the market. Then the buyers are going to be located at the what? At the low of the candle. At the low of the candle. So we look at the low of the candle, then we identify what? Demand zone. We look at the high of the candle, then we identify what? Supply zone, right? So something like this, maybe you want the higher time frame, a daily time frame of the 4 hour time frame. You move on to the lower time frame, then we try to what? Identify a pattern like this, right? A bearish engulfing candlestick pattern. We mark it and we anticipate price to what? Come to it so that we drop, right? We are on the higher time frame, let's say daily or 4 hour time frame. We have just one candle. What do? We look at the low of the candle. We find a bullish engulfing candlestick pattern. We mark it and we anticipate the market to what? Come into it and what? Rise. So that is as simple as that. Nothing complicated. Okay? All right. Now let's look at the ugly side. Every coin has two sides, right? What you must notice is that sometimes the market is not going to come to the what? Very tip of the candle before it drops, right? So in case of supply, it can just react in the middle of the candle and drop. And in case of a demand, it can just react in the middle of the candle and what? Rise. This is as a result of support and resistance what levels. So maybe there's a very sensitive resistance level that is within the candle over here. So for that reason, price is not going to get to the what? Supply, but just use the resistance level to what? Drop. The same thing applies to the what? The demand zone. Maybe there's a sensitive support level over here, so the market is not going to get to the demand, that is the low of the candle, but just react in the middle of the candle and what? Rise, right? So that is one thing that you have to take into consideration. It can also be that there are a lot of other supply zone within this candle, so the market is not able to take the extreme supply zones. It happens, but you should be able to understand what you are looking for. What we are looking for is that we are looking for the market to get it to the tip of the candle so that we can take a trade, right? If the market reacts in the middle, we are not interested and we are not going to what? FOMO in. All right. So I believe that is clear. Let's go to the chart and let's look at how we can apply this little trick to identify every single supply and demand zone on the chart. All right. So now we are looking at gold. We are going to use gold as an example. I already marked some examples over here. So let's go to the 4 hour time frame because we want to start the analysis from the what? From the higher time frame, okay? And now let's look at something over here. Let's look at this area. Now we can see that price closed bearish over here. Now this thing that I am trying to use should be accompanied with other confluences like market structure shift on the lower time frame, because if the market has not shifted bearish, you have no business trying to what? Go bearish. So maybe I'm trying to show you something over here, but when you go to the lower time frame, the markets will still be what? Doing higher highs. At that point, we have no business what? Trying to sell. But if the market breaks the most recent higher low, then it does what? It makes a lower low, then you can anticipate a lower high and what? A drop. That is when you can apply some of these things. So it must be in context with what the market is already doing, not what we think the market is supposed to do. So the market should be already in the same trend direction that you're trying to what? Take the trade towards. That is going to help you a lot, avoid a lot of what? Losses, right? Okay, so now you can see that we have this bearish candle closure over here. So we are anticipating the next candle to what? To close bearish also. So you mark the high of that candle. You have to wait for this candle to what? Close bearish. You don't have to anticipate that it's going to close bearish or it's going to close bullish. We mark the high of what? That candle. Then you move on to the lower time frame where you can see the market structure around here clear. You have to wait for that market structure to shift. Then you what? We take your trade. All right. So let's move on to the 1 hour time frame first. I don't see anything. Let's move on to the 15 minutes time frame. And this is how you are supposed to analyze the market. Move to a time frame where you see the market structure clearly, not a time frame that you think you should what? You should use, right? So if you check this price action over here, you can see that the market was making higher highs, right? So you made a low, you made a low, you made a high, and then you made a low. So we are expecting what? A higher high. So this is not a good place to what? Apply what I'm trying to what? Show you. But just for the sake of examples, that is the reason why I'm what? I'm trying to show you this, right? So you have no business trying to sell the market from here because the market is already making what? It's already making higher highs, right? So this is not a very good scenario to short the market. But like I said, for the purposes of example, that is the reason why I'm trying to what? Show you this example, right? For this particular trade. So what did I say supply and demand zones look like on a chart? Right? So now we know where to find it. We saw that we are supposed to find it at the tip of what candle. So somewhere around what here. How does it look like? It looks like bullish and bearish engulfing stick pattern, right? So you can see that we have this huge bullish candle that was what engulfed by the consecutive bearish candles that is sitting right here. So that becomes a valid what supply zone. Okay. So what you do is that you position for a sell around that area. Okay. Don't put your stop loss exactly at the head, like at the tip of the candle. That is not a good practice. Leave a little bit of room just in case spread takes you out or the market tries to trade a little bit higher before it dumps. And you can target maybe 1:2 or 1:1 based on your preferred risk reward ratio, right? So let's look at the next part. Let's look at the next example. All right. So this area, you can see the market. Let me expand it a little bit. You can see the market closing what? Bullish, right? So you anticipate the next candle to also what? Close bullish. So you mark the low of that candle, then you go to the lower time frame. Make sure it is in the direction of the trend before we take it. Okay. So let's move on to the 30 minutes time frame. Okay, this is it. So this is the low of the candle that we have. What did we say supply and demand zones are? They are just bullish and bearish engulfing candlestick pattern. So like I said, it can be a single candle or consecutive what? Bearish candle. So in this case, since you are talking about demand, we are talking about what? A bullish engulfing candlestick pattern. So what do? We mark that bearish candles that has been what? Engulfed. So this area, you position for a long, you position for a long. Around here, your stop loss goes below the zone. You leave a little bit of room for spread, right? Then you can target maybe 1:2. Okay, or 1:3, depending on how you do it. So have you seen, this is very simple, very mechanical. You don't have to guess anything. Everything is being given to you by the price action. So let's look at this area over here. We have this candle closing what? Bearish. So we're anticipating the next candle to also what? Close bearish, right? So we go to the lower time frame, the 30 minutes time frame if you want to use that. All right, so this is the area. So we can see that this is the tip of the what? The tip of the candle, right? So what do? We find since we are talking about supply, we find a bullish candle that has been what? That has been engulfed. So let's look at it. This is the bullish candle that has been engulfed. We mark it, then we anticipate the price to come then what? And dump. Okay. So we take a short trade from there, take a short trade from there, then it targets maybe 1:2 or 1:3. So that is that, guys. That is just literally what we need to do to identify your supply and demand zones. And you have to start from the higher time frame, right? You have to literally start from the higher time frame, as you're going to get what? Confused. And one pro tip that I should tell you about is the candles have to be what? They have to be doing a clean range. It doesn't have to be consolidating, right? So you can see that this area we had multiple bullish candles moving in the same direction. Then we had what? Bearish candles. So at that point, you can anticipate that the next candles are also going to follow through the what? With the bearish candles that are what? Coming. So clean range in, clean range what? Out. And the market structure has to also shift on the lower time frame before you trade in that direction, right? So that is it, guys. As simple as that, nothing too complicated. And I hope this video actually helped you understand or gained more insight into supply and demand trading. If you don't understand anything, once again, leave a comment in the comment section and I will come and attend to you. And if you have any questions, you can maybe, yeah, still leave it in the comment section, of course, and I'll still come and attend to you. Don't forget to like and subscribe to help us grow the channel. Daily FS out.